Okay, let's get going. Good morning, everybody. So busy day today because obviously we've got Andy McHattie on talking about what happened during September. And our guest this week is Richard Brown from Carthew, which is an interesting trust. I think one we ought to get to know better. So bits of news first. I've put up 4 things. They're all quite short. You'd be pleased to hear. And then we'll get to Andrew. But we'll start with the Atrato Onsite Energy. Normal kind of picture here where the share price falls off a cliff. But in this case, the NAV has been slipping and it's really disappointed investors. It's not very big, 115 million market cap. The discount, even after this jump, is still about 15%, and it yields about 7%, but that's maybe moot now. So what it said was on the 3rd of October, it's going to sell its entire portfolio to Brookfield and Apollo for about £218 million, £290 million. That needs shareholder approval, obviously. So there's a meeting now scheduled for this on the 22nd of October. So really, we're really sort of motoring with this stuff. That deal should complete if it gets approved by early mid-November. Then shortly after that, there'll be another circular to approve the liquidation of the company. That will mean it gets delisted. I think so. Basically, the meeting will probably be end of November in December and delisting in December, but you won't get the cash until February when everything settles down. Nevertheless, that quite speedy in the scheme of things. In terms of the amounts, they're talking about 80p, which is an 11% discount to the last published NAV, 25% premium to the pre-announcement price. It's not too bad. It's not amazing, but it's not too bad. I would doubt we're going to get much of a counter bid here, if anything. So I think this is probably the situation as it finishes. Obviously, disappointed investors, and that's why people wanted it done. So fair enough. Talking about disparaging investors, here's Keystone Positive Change. That is a 10-year chart, and you can see how bad it's done over 10 years, really very poor. The discount has been tracking in a bit over the last year and a bit. So I think partly that is stake building by some activists, one of which notably is Saba Capital. Again, it's not very big, so it's been that's not a huge stake that they've got monetary wise. The discount's gone into 6.5%. There doesn't seem to be enough wiggle room left in it now. We talked about this back on the 13th of September anyway, and nothing's really changed, but what they have announced here is that sort of the more detail. Again, there's a cash exit if you want it, but as a discount to the formula asset value. I don't see why anybody should take that, to be honest. It's much better to roll into the open-ended fund, which is the alternative, and then immediately hit the redeem button, and then you should get out at NAV. There's a wrinkle in all of this. So 4.3% of the portfolio, what they said is they're going to do, they're going to put the unlisteds into like a sort of side pocket thing. They'll liquidate them over time and then give you the cash back separately. And that depends, that's regardless of whether you go for cash now or roll into the other fund. So that will obviously take time to unwind, and that's a good reason why it's sold at 6.5% discount. Residential Secure Income, another subscale trust, about £100 million, but one actually I quite liked. It's on a big discount, it's on a big yield, and it just really didn't get big enough. So it launched in 2017. It's a mixture of sort of independent living for retired people and shared ownership homes for people who can't afford buying a house outright. They did have some local authority accommodation. That's all been sold now. And that was actually sold at premium to book value. And that would mean they can pay off their floating rate debt. So it's just a mix of the retirement living, which is the big chunk, and then shared ownership stuff. And you can see that down there. And these were quite attractive, really. So they're inflation-linked leases linked to RPI, which is obviously higher than CPI, with a cap, so 6% for the independent retirement flats and 5.5% for the shared ownership stuff. And that had a floor in it as well, in case we ever get back to deflation. That seems unlikely for the moment, but we never know. And there's a bit more information on the portfolio. So reasonable yields with a bit of leverage in there. So actually quite attractive leverage yields and very good kind of occupancy and rent collection stuff. So there's really nothing wrong with this at all. We're not talking about a home REIT or triple, there's nothing wrong with this at all. But it's just too small. So investors seem to want their money back. So that's what's going to happen. It's going to be a managed wind down. I think you'll get a lot closer to NAV than the current share price is implying. So that there might be some room there for that discount to narrow. But yeah, it's a small thing. You might want to play that. Triple point energy transition. I'm only mentioning this because obviously this is already management wind down, but it's with these aren't white greenhouses. So go all the way up to SQN. It financed these. It's never really worked for everybody. It's always been a sort of person with something wrong with it. So it sold the loans that it had against those, which is it's a combined heat and power plant that supplies heat and I think carbon dioxide to these glass houses where they grow tomatoes. And it was supposed to get 17.5 million, most of it up front, and then some stage payments. And they've already basically had a default on the first of these three stage payments. And they're talking about a payment plan of P3P partners, who are the people they sold the loans to. I don't know what this says about P3P partners. Maybe they're struggling. They've got all sorts of interest in all sorts of pies. But obviously they'll be exposed probably to falling power prices. We'll have to wait and see where that sort of thing. Maybe more news on that later on. But I think the interesting maybe thing for Tent shareholders is that if the money is available, they might get all of this money faster because of the default. And I think that's kind of what that comment is saying here about all amounts due under the promissory note. So actually, this might turn out to be good news for Tent if there's money available. We'll have to wait and see. So that's enough from me. I'm going to hand over to Andrew.
That's great. Thank you very much indeed, James. I'll just switch to my screen. What a lot of miserable news you gave us there. A lot of rotten tomatoes. So I'll see if I can provide something a little more optimistic about trusts that do have scale. So let's have a look at the movers. And there were some quite big ones actually this month. Clearly, those three at the top are quite exciting, and I'll talk about those. And a lot of corporate action took place and resulted in some quite good, strong share price gains. So we saw Chrysalis Investments starting its buyback program, partly with borrowed money, which is a curious precedent, not particularly one I'm keen to see followed. Balanced Commercial Property Trust received a takeover bid. Aberdeen Property Income sold its portfolio. Menharden Resource Efficiency instigated a strategic review. So there's quite a lot going on, and this is reflected in some quite interesting share price movements. But inevitably, the ones I'm going to talk about are those three at the top. So I'll come on to those. On the downside, again, one or two outstanding features. On the subject of curses hitting investment trusts, Ecofin US Renewables has had a similar kind of path, hasn't it? If you remember, it was hit by a tornado that knocked out its big operation in Texas and subsequently had further operational issues. That's going to wind down, but if NAV has come down, Digital 9 infrastructures on there again. Hydrogen One Capital Growth. Some of these trusts seem to appear on the list quite frequently. And on the subject of things that appear frequently, I will talk about Schiehallion Fund, which is probably the most regular participant on this list, and also two of the healthcare trusts, which fell by just over 6% over the month. So let me crack on and talk about China, which has had an utterly spectacular rally. And this is quite staggering, actually. And I think it's interesting just to consider how it came about as well as the actual result. Because, of course, in the UK here, we're waiting with bated breath for the budget to come on October 30th. It's all been diarised, it's in the calendar. We have seen a lot of discussion, a lot of the potential ideas I think that the Chancellor is juggling with have been floated in the media to see exactly what the market reaction is. So much of that is signalled in advance. In China, things just happen differently, don't they? And there's been this staggering stimulus package that came from nowhere and I think was really completely unexpected, which is why it's had such a big market impact. But this is what totalitarian government can do. I mean, it can deliver changes very rapidly without this need for public discussion or for any form of consensus. And that can be good and bad, but it certainly creates this extra volatility in the market. And in this case, the stimulus package that has been proposed is enormous. It's about £100 billion to begin with, which is really that's the monetary easing part. And I think there's some fiscal easing to come with it. And this is because the economy was clearly not meeting its growth targets. And I think for that reason, China was massively out of favor with investors. Nobody I was talking to was ever proposing any Chinese exposure. They were really talking it down, saying, well, we don't have very much exposure to China. Isn't that a good thing? And so the markets were completely out of favor, which means that they've soared in response to this, really on a scale which was completely unexpected. And this has meant that all three of the specialist Chinese trusts have moved very sharply higher. I'll show you that on the chart now. And it really is dramatic. This is a 6-month chart, which I felt was the best way of presenting this. And you can see that for most of the last 6 months, these trusts have been out of favor, slowly sinking in value, and really nobody's wanted to touch them. And so we've had this very, very sharp rally. And in fact, I created this chart yesterday. Had I updated it this morning, those lines would have gone even further north because the rally is still continuing. So it's been a very dramatic reversal of this period of weakness. And of course, the question everybody wants to answer is whether it's going to be sustained, whether this market rally is going to just fall back again, or whether it's going to move on further. And I think that's incredibly difficult to gauge because you're dealing here, as I mentioned, with authorities that have absolute power. They can decide exactly what they're doing, and they're not necessarily going to flag that to the market. So it's pretty difficult to anticipate exactly what's going to happen next. A lot of managers are now going to address this, of course, and there's quite a lot of briefings set for the coming couple of weeks, which I'll tune into to get some better idea of what they think. But I think it's very difficult to gauge whether those three Chinese trusts are going to move higher or lower. I think the thing I can probably indicate is that they will be on the list of movers next month. I just don't know which side of the the list they'll be on. So I think perhaps a sensible approach is to look beyond those three trusts and to consider other trusts that could be beneficiaries of a more positive environment in China and some re-energization of the economy there. Certainly, I think beneficiaries of global trade could well prosper from this. I think perhaps the two shipping trusts are relevant there. And I think as well the rest of Asia, because clearly the health of the Chinese economy has a big knock-on effect throughout the rest of Asia. And my impression so far is that the rest of Asia has not rallied that much. And so I think there could be opportunities available in other more general Asian trusts. I've listed some there, and I think the first one, the first ticker code there, DGN, I mean, that's Aberdeen Asia Dragon Trust. I think that's particularly interesting because, of course, it's still waiting for the result of its strategic review there, which has been going on for quite some time. So maybe you've got a double-barreled opportunity there. I think as well, if we're thinking about this subject more broadly, it's worth reminding ourselves that China was really quite hated just a couple of weeks ago, and now it's had this enormous rally. And that's a handy reminder, actually, that out of favor sectors can indeed come back into favor quite rapidly. And it made me think, actually, about the renewable sector, which has really fallen well out of favor. Obviously, James was just talking about trusts winding up there because they're not seeing sufficient demand and because their ratings are too low for them to raise more capital. I was talking to one of the major managers in the sector this week, and he reckons there's going to be quite a lot of consolidation to come in this investment trust sector, and that, of course, could re-energize it. And there's certainly, I think, an impression now that deals are getting done. So that was interesting with Atrato Onsite Energy there selling its portfolio. I think we are seeing these deals being done now. We might see further consolidation, and I think as well, the Bank of England is indicating that it might be a bit more aggressive on interest rate cuts in the coming months. And if that does indeed transpire, then I think, again, that could be very beneficial for that sector. So that's a slight side issue, but I think it's interesting. And just a reminder that actually we shouldn't have views that are too hard and fast on individual sectors. I'll just move on to the Schiehallion fund, which I think appears on this list all the time. It is very volatile, and really on a very frequent basis, it's either rising or falling by double-digit percentage terms. So I think it's just worth reminding ourselves of what this trust is about. I mean, it's clearly a volatile share price on a big discount now of 33.6%. But this is a Baillie Gifford managed trust that is a private. It buys privately held companies, normally late stage companies that might be gearing up for public markets or for sale. And you can see on the right hand side there the list of top 10 holdings. The one at the top is the one that normally attracts all of the attention. Space Exploration Technologies, that's the Elon Musk company, and that's quite a big chunky holding here, along with ByteDance, which owns TikTok. And these are companies that are clearly developing rapidly, have a great deal of latent value in there. If they were to IPO or to be sold, then they could raise significant amount of money for this trust. It's not surprising it's volatile. I mean, it does revalue its assets frequently, but the volatility here isn't really coming from the NAV. It's just coming from share trading. And my feeling is, having looked at the volume figures, which are not very high here, I think it's quite an illiquid trust where many of the holders are actually quite solid holders. They're not trading it. And it means the actual liquid float is not that large, although it is actually quite a big trust itself. And I think whilst that current discount does look very attractive, actually it's not out of line with other direct private equity investment trusts or trusts like Chrysalis Investments that are in growth capital. So I'm not sure it's an opportunity, but it's certainly interesting. And we have seen this enormous volatility over time. The red or orange line at the top there is the NAV, which hasn't moved very much over the last year. Well, this is the year to date. So that's not what's driving the volatility in the share price, which is the blue line here. And that really is very volatile. I mean, it's moved from about 60 US cents at the bottom here to $1 at the top. So it's a big range. It's back down to about 80 cents now. And you can see at the bottom here, this is the discount, which again has obviously varied enormously. So I do think it's a very interesting trust to watch if you are interested in short-term trading, which is not really what investment trusts are about, but they can be used for that. This is perhaps a trust to think about, although the dealing spread is not the keenest, and it's in US dollars, so you have a currency risk as well. So anyway, an interesting one, and I dare say we'll just see continuing volatility here. So I'll move on to healthcare and those two investment trusts with Bellevue Healthcare and Polar Capital Global Healthcare, which both fell by more than 6% over the month. Those two trusts don't have that much in common apart from the sector. Their holdings are not particularly similar. So I did think this was probably a sector-wide decline. And having looked into it, I think that's the case. So Again, this is a year-to-date chart. It shows the US healthcare sector, and it's really the US which is relevant here. The US healthcare sector is the blue line against the yellow line here, which is the broader market, the S&P 500. And you can see the degree of underperformance here is quite considerable in 2024 to date. So the healthcare sector is up. I mean, it's not been a disaster, but it's up by 10% compared to 20% for the market. So it's only delivered half that return. And clearly the market has had a lot of that momentum from tech companies. And so I think probably you will find many sectors have underperformed the S&P in the near term. But that's why these figures at the bottom are interesting as well. Because if we look at the longer term figures here, the 1 year, 3 year, and 5 year returns, again, they all show considerable underperformance by healthcare. Over 3 years, it's really quite dramatic, only 7% from the sector compared to 31% from the S&P 500. So this is not a new phenomenon that healthcare has underperformed. And I find this quite difficult to reconcile with the extremely positive narrative that comes with this sector and from the managers who all talk about these tremendous tailwinds of demographics, which I think they're undeniable. We have an aging population in Western economies, and more healthcare is demanded. There's a lot of great innovation in the healthcare sector now. The FDA is approving more drugs than ever. Really, the narrative behind it all is very strong. It's just not matched by performance. And in part, that the resolution of that comes out in the valuations, which are low in this sector. So again, I mean, I think it's an interesting question for you to wrestle with, whether this underperformance makes it a great bargain. And again, we'll see a reversal here, and we'll see healthcare eventually come back into favor, or whether in fact it's a perpetual underperformer in spite of the great story, because we have seen that in the past. So the next question, I think, is, well, given this underperformance, can I maybe pick up some healthcare trusts on a great big discount and put them in my portfolio and be patient with them? And the answer is, well, no, actually, that healthcare trusts are not particularly cheaply rated. I've got the listing here with the discount on the right-hand side. If we look at the major ones, we've got Bellevue on an 8.9 discount, International Biotechnology on 9.5, Polar Capital 5.4, the Biotech Growth Fund on 8, Worldwide Healthcare on 10.2. So those are okay, those discounts, but they're nothing outstanding, and they're narrower, in fact, than the broad investment trust average discount, which is more like 13.8. So I don't think there are particular bargains here to be had at this time. So that doesn't really help with resolving the question I posed. I do think one interesting one here is RTW Biotech Opportunities on a 25 discount, sometimes thought of as being a trust of private investments. It actually has a mix of private and public, and more public at the moment. And I think a 25 discount there is probably quite generous. I'd just like to finish actually with a little bit more about this trust. There's one specific item I noticed that I think is worth talking about. And that is that this trust currently has two classes of share, or actually it doesn't. It has one class of share, but it has two quotes listed on the London Stock Exchange. There's the RTW dollar quote, and there's the RTWG sterling quote, which the trust has decided to dispense with. As you might on the surface think, well, that's quite bad news. Surely for UK private investors in particular, you want to be able to deal in sterling. So removing that is reducing my choice and reducing the availability. I think the exact opposite is true. Actually, I think this is a very good move. And I've been asking the company about this for a while, actually, because in fact, those two quotes are for the exact same class of shares. So there's no negative implication here for current shareholders who bought them through the sterling quote. You just transfer straight over to the dollar quote. That's no problem. And actually, with modern stockbroking platforms being able to execute all of the foreign exchange for you completely automatically, cheaply and simply, there's just no need to have this separate sterling quote. And I've been frustrated for quite some time that one of the biggest stockbroking houses, in fact, the biggest, has been forcing people into these sterling quotes rather than allowing them to choose between the sterling quote and the dollar quote. And the reason I don't like that is because the sterling quotes tend to have much wider dealing spreads. In the case of RTW, I checked them on Thursday. The dollar quote had a spread of 3.3%, and the sterling quote a spread of 6.7%. It was actually just more than double. So you were being penalized for taking the sterling quote there, and that seemed wrong to me. So I just don't think they're useful, these quotes anymore. There was a time when they were, because it was more difficult to do the foreign exchange through your broker, but that's not true now. So I think we might see some more of these disappear. I've just listed on the screen there quite a number of other of these secondary kind of dollar-denominated trusts that do have sterling quotes. I don't think they're valuable, so I think we might see a few more of those disappear, which just saves a few pounds for the investment trust, which is good common sense, but it also simplifies it, and I think gives investors the best opportunity to deal on decent terms. Just before I finish, I can just see there's a question about Pantheon Infrastructure, which was on the list of movers. I think this is a well-regarded trust, actually. I haven't written about it for some time, but I know certainly amongst the broking community, it has a very good reputation, and I expect you've written about it as well, James.
Yeah, we have. Yeah, and we like it. So
Yeah.
and it's too cheap. So we go. Cool.
Great, thank you.
Thank you very much indeed, Andrew. I'll go back to my screen again. Yeah, it's a lot of interesting stuff you covered there.